Hello. We know that account balances of a company's accounting book follows an accounting standard, such as the US GAAP. In order to calculate income taxes, these account balances needs to be adjusted to the tax balances for each of the account. And tax balances follows a tax regulation, not the accounting standard. And some of those adjustments are permanent in nature in that they will not reverse in future years. Here we will use a simple example where the B2T engine makes such a permanent adjustment for an account, adjusting its book balances to tax balance. And we will also show how such an adjustment impacts the company's taxes. So let's take a look at the example, the hello world example, where we want to calculate a US company P that has a revenue of $1,000. Let's assume that P also has a meals and entertainment expense to entertain its clients of $100. So P has a me exp 100 expense. So notice signage over here, debit plus, credit minus. And further, we need to tell the B2T engine what exactly is this account. So we go to the setup in the account mapping table, and we're going to let the B2T engine know what exactly is the account. So here's a record. We basically tell the engine that the ME expense account is mapped to a meals and entertainment expense account. That's the standard account, so that the engine will know what to do. So we save it, and we go to the recurring input sheet. Here's the easy button. We submit it. If the engine happens to start cold, it may take 20-30 seconds to warm up. Otherwise, it'll be rather quick. So it's done. Let's open the output file. We look at the calculation for the P and for USA, and its tax is 210, but the effective tax rate is 23, which is more than the US corporate rate of 21%. Why is that? Let's go over to the detail sheet where we can find the logic of it. So here's a detail sheet. The most importantly, here are the critical book to tax adjustments. We have 100 credit adjustments on the meals and entertainment account. It used to be a debit 100. Now we adjust the credit 100. So essentially add back the expense into the account. Why is that? So let's jump over into further details. So details, this is account level details. We see the adjustment value is credit 100. And here are a lot of details. First, the engine tells you it's a permanent type of the adjustment, and it tells you the calculation logic and pointing out the specific rules that's being used. It also tells you the accounting treatment. It simply recognizes it as the expense. If you spend 100, it's an expense. However, the tax treatment is different. The tax says, okay, it's not deductible for tax purposes. So now that's why it is adding back the credit value here. So here is why the adjustment is being calculated that way. How would this adjustment impact the tax for the company P? So let's go back to the provision sheet. So here for this account, we have the adjustment of credit 100. And let's take a look at the current tax expense calculation for the company P. We start with the pre-tax book income of 900 because we have revenue 1,000, but there's an expense of 100, so therefore the total pre-tax book income is 900. However, we look down, there is a permanent adjustment from this account that is credit 100. So over here, this credit is adding back into the book income to arrive at the taxable income of 1,000. So you have the current tax expense is 210. Okay, that's why it is 210. And we go down further, the deferred tax expense, we see there's no impact from the permanent adjustment. It's all zero over here. And we go further down, we have the rate reconciliation that explains how the effective tax rate is being calculated. We see we start with 21%, but we have an impact item from the meals and entertainment of about 2%. So in the end, we have an effective tax rate of around 23. So to summarize, the only thing that a user needs to do is to map the account to a standard account properly. Then the B2T engine will automatically make the book to tax adjustments and will automatically calculate the tax effects of those adjustments. Users do not need to keep track of the accounting standards and tax regulations because they keep changing. The engine knows all the rates and rules and will apply those rates and rules that are enacted for the accounting period. That's it. Thanks for watching.